Ever heard the term capital thrown around in business news and wondered what it really means? Let's break it down in under 2 minutes. In the world of accounting, capital is a fundamental concept that goes beyond just having cash. Capital represents the total financial value of assets that a business can use to produce goods or services. Think of it as the financial fuel that powers the company engine, essential for operation and growth. The simplest way to understand capital is through the basic accounting equation. This equation states that assets minus liabilities equals capital, which is also commonly known as owner's equity. Assets are what a company owns, such as buildings, equipment, and other valuable resources. Liabilities are what a company owes to others, including loans, debts, or other financial obligations. Let's use a quick example to illustrate how this works in a real-world scenario. Imagine you start a coffee cart business. Your coffee machine and the cart are assets, valued at $5,000. But you took out a small loan of $1,000 to purchase those items. That's your liability. Your capital or equity in the business is $4,000, the $5,000 in assets minus the $1,000 in liability. Capital can take many forms, including cash, machinery, buildings, or even intellectual property. It is generally divided into 2 main types. Working capital is the money used for day-to-day operations, ensuring the business can meet its short-term needs. Fixed capital is invested in long-term assets, such as machinery and buildings, essential for the business's longevity. And that's capital in a nutshell. It's the foundation of a business's financial health. Understanding this key term is your first step into the world of finance and evaluating a company's stability. If this video helped you, hit that like button and subscribe for more quick accounting lessons.